Inflation is easing, the stock market is soaring, the Sensex and the Nifty at their highest level in 13 months. Bank stocks lead the charge. 4 weeks of gains for the Lal Street. What next? Hello and welcome to Editors Roundtable. I'm Reema Tendulkar. With me is Prashant Nair, Anuj Singhal and Nimesh Shah. Hello, boys.
Hello, and
what a week, right?
What a week, and what a way to end it, actually. And the way the US market sort of gave a bit of a false alarm, and after that, that massive breakout, almost everything going for us. Dollar index 108, bond yields crashing, whatever could go right for the market gone right. HDFC Bank, coming back to life on Friday. So much happened over the weekend, despite it being a truncated week, actually.
And this just underscores the...
disappointment maybe this week was that we lost out in the semi-finals. And back to that badly. So I think that was the only story point.
Made up with the Friday rally. I mean, somewhat, right?
Somewhat, yeah.
Not fully. Anuj, you were awake for the last big overnight session.
This time I was not. This time I was not. This time I was not. I think once is enough, Prashant. At 42, I think you have to plan these, You can't be awake for everything.
But it just underscores the importance of staying invested in the market, right? Because days like these, 5.5% on S&P, 7% on Nasdaq, come out of nowhere.
Yeah. And a 20 basis point, actually, if you think about it, it's a 20-25 basis point miss to CPI inflation.
Exactly.
A 20 basis point miss in inflation leading to a near 7-8% rally in the Nasdaq and 5-5.5% of the S. These are not some faraway emerging markets. The largest, most liquid market in the world. It's amazing.
The fall was also like that. It's almost like a spring which has been roiled and it's just about to release the energy, and you give it. But I think, Prashant, I take your point on the inflation. I think the markets assume that this is it, and that Mr. Powell has won that battle. Yeah. What if next month it comes back and raises its ugly head? So I don't know, but every month is different.
But if you see a lot of global indicators, technical indicators in the US. Are suggesting a rally from here. Post the midterm elections, normally see a 18-20% rally in the S&P. Post Nasdaq rallying, in one day 7-8%. You see a big move in the Nasdaq as well. So those, the technical, all the parameters are suggesting a bit of upside in the global markets. So maybe that will help us.
Nimesh, they say that the largest moves, and we've all seen enough markets, largest moves happen in vicious bear markets, right? The biggest of the moves. Right. One just hopes that, as you said, the next month inflation numbers are well behaved and they're not an ugly surprise. Yeah,
and the scared bear is the biggest bull, right?
So the biggest bull.
The bear got scared a bit, so maybe that also.
But let's talk about the global setup, right?
Yeah, no, absolutely, Reema. I'm going to walk across to the wall because the global setup is really the sort of big thing this time. And I'll tell you why, right? As I said, the topic is when good news is simply good news. I'll tell you why. All of this year, how many times have you heard the phrase good news is bad news, which is data is positive, which means that Fed will tighten. So good news is bad news. And bad news, bad data is good news, which is, labor market data sort of is weaker, claims data is higher, which means economy is slowing and, Fed will loosen, which is bad data is good news. But this time, for the first time this year, I think we can say good is actually good. Good news is good news unambiguously. And the moves are massive. Even those who watch markets for 15, 20 years, these are moves which you don't see very often. This is the rates market in the US, the most liquid market in the world. The 2-year, the 5-year, the 10-year, 30-year, we saw 25 to almost 30 basis point falls across tenors. In percentage basis, this is across the board 6% fall in the US government bond yield curve. That is massive. Let me tell you how massive this is. If you go back all the way to 1980s, there are only 5 instances, if we can move on, there are only 5 instances of the US 2-year yield falling by at least 20 basis points from a 200-day high in the prior 10 days. Let me explain this. If the 2-year yield is at a 200-day high, there have been only 5 instances that, within 10 days of that high, the 2-year US government bond yield has fallen over 20 basis points. And what happened last night was one of those instances. This is 1987, 88, 90, 2022, which is the FOMC. Of course, the market bottomed around there. And then yesterday, which is the 10th of November. So, the magnitude of the moves, absolutely. Will the moves last is the question. And for this, you know, the sample size is small, just 4 instances. So one cannot make sweeping statements, but we work with what we have. And I just looked at 2 things, dollar index and the 2-year yield, rates and dollar. These are the 2 most important channels via which global financial stress seeps into the market here. It pressures the rupee, it pressures deficit and things like that. What happened in the 4 instances last time is that the dollar index was down another 4% over the next 2 months, right? When this happened, and the 2-year yield bottomed out only after 2 months. So this 2 months is common, which means that for the next 2 months, if you go with the last 4 instances, maybe we'll have a little bit of stability. We won't have ugly surprises. But as I said, you only have 4 instances. That's how rare this move last night was. I'll leave you with a bit of a word of caution, which is, I think, also necessary. This is Citi's economist who says, and I quote, markets continue to overestimate the likelihood that some version of the risk-positive, transitory inflation, Fed pivot, soft landing narrative will play out. He's saying, well, this is overestimation. The economist from Morgan Stanley saying a stronger than expected December payroll sprint could still complicate the issue at margin. And then you have CLSA who acknowledges that the payrolls data was stronger than expected. October CPI, while it is good, but one needs to keep a sense of perspective and not get carried away. So that's basically where some of these guys are at. And I think it's only fair, take the good as good, but also at the margin be a little careful. Back to you guys.
Yeah, you know, and very interesting points Prashant made over there. The other thing actually is that we've seen a lot of ETF inflows into our market because ETF money chases momentum. Now, if you have the kind of momentum that US market started to show yesterday, 7% rally in the Nasdaq, and today all things being told, the Indian markets move actually was a bit disappointing after a gap up. I mean, the mid-cap index actually was in the red. Yeah. So going forward, actually we're nicely decoupling. So you don't want the decoupling on the other side, which is the US as well, and you know we don't do well.
Exactly.
Especially
but I guess
so many emerging
what will happen is,
yeah.
you know, Anuj, what will happen is maybe within Indian markets we'll see a bit of decoupling. For a longish bit, the mid cap and small cap are outperforming. I guess now it's a time for the large cap leaders to take the leadership role and support the market. So we saw this today, right? The HDFC Twins, Reliance, and Infosys. If you look at those 4 stocks, they added 1,000 points to the Sensex rally of 1,050 points. So if barring those 4 stocks, the Sensex was also flat, so to speak, in today's trade. So 50, there is leadership now back.
50% of the Nifty gains came, 150 index points came from
those 4
HDFC
stocks.
and HDFC
Absolutely.
Bank. Anuj, you're talking about HDFC Bank, right? And how potentially it could gain leadership back.
You know, I'll tell you one more thing, and I'll just go to the big wall. The lopsided nature of the bank Nifty. Talk about contribution. HDFC Bank contributed 800 points in a 500-point Bank Nifty rally. So it tells you what the Bank Nifty was doing, right? But you know what? Just look at what the individual stocks have done in the Bank Nifty and why today could mark a bit of a tectonic shift in HDFC Bank if it does. This is the move that we have seen in the big banks. This is 1-year move and this is 3-year move because, 1 year, it's okay, a stock can eke out outperformance. But when it's a 3-year move, just look at what ICICI Bank has done compared to HDFC Bank. ICICI Bank's 1-year move is 19% and 3-year move is 162%. Look at HDFC Bank. We just keep saying that it's underperformed, it's underperformed. It's underperformed how much? Over a 1-year period, it's up 2%, counting today's rally, by the way. And over a 3-year period, 26%. That's a very big difference, 136% difference. And look at Kotak Mahindra Bank. It's actually fallen over a 1-year period. It's down about 7%, while it's only up about 19% over a 3-year period. Now, I keep saying that Bank Nifty is a very lopsided index. Just look at the Bank Nifty weights, and this actually is a stunning plate. Now, HDFC Bank plus ICICI Bank is 50% of Bank Nifty for longest. But 3 years back, this 50% was divided as 30% for HDFC Bank and 19% for ICICI Bank. Look at what happened now. If we didn't have this rally today, ICICI Bank could well have overtaken HDFC Bank as Nifty's #1 contributor for the first time in history. That didn't happen, and it's now unlikely to happen maybe. But 25.6% for HDFC Bank and 24.6% for ICICI Bank. Axis also has been a bit of an underperformer. Of course, SBI has been quite stable. And look at Kotak Mahindra Bank. It used to have 13% weight. It's now fallen to 10.9%. Now, there's another interesting thing which actually Nimesh told me, and I just looked at the data after that. Look at what HDFC Bank ADR is doing. HDFC Bank ADR used to enjoy a premium over the stock here. Now in May 2022, it started to trade at a discount. which was never heard of. That was the kind of hate that HDFC Bank stock had. Almost everyone was just giving up the HDFC Bank stock. It's currently back to 18% premium, which is indicating that FIs are already buying it via the ADR route. Now, of course, let me give you the news, which is now well documented, what happened today, which is from the brokerage note that we found out that the MSCI has changed the methodology for M&A, and which means that the requirement of minimum foreign room is done away with, which means that potentially HDFC Bank's weight, the twins' weight could actually go up. It could go up to double, and that was the reason that you saw this big rally. So that's the HDFC Bank story. But I tell you what, for me, the dark horse could actually be Kotak Mahindra Bank from here on. And the reason for that is very simple. As I said, it's actually underperformed even HDFC Bank. And FTSE's review is due in March. Now, it missed out in the inclusion in the September semi-annual review because of that time factor. It could not give that shareholding pattern in time. Now, the FI room in stock has opened about 20%. So maybe in the next review, it should get in. And that would mean that a potential inflow of about $1 billion in Kotak Mahindra Bank. The short story is that basically the underperforming banks, remember, Axis Bank has already corrected some of its underperformance. HDFC Bank has started to do it. Maybe it's time for Kotak as well to start correcting that underperformance.
The point is that these are market-weighted indices, right? Yeah. As Anuj also said, because if and it's true for all indices, Bank Nifty, and we often wonder, what does well gets bumped up, it gets a higher ranking. What does not do very well, it kind of is thrown out of the index, but not these stocks. But the point is, these are momentum, market-weighted index. It essentially is a momentum index, and that's why.
The other point is, generally, you've seen historically in the last 2 months of the year, the underperformance start to outperform. In the sense, the money shifts from outperformers to underperformers within indices, within stocks as well. So maybe it's time for the underperformers to do a bit of a catch-up. Money will flow into those stocks. Yeah. So generally, there is a rebalancing happening towards the end of the year. And historically, the data suggests that the outperformers tend to underperform in the last 2 months, and the underperforming stock starts to see some bit of momentum, and the money starts chasing them. So even that could be a play factor for the likes of HDFC Twins, Reliance, and all those stocks.
If this rebalancing theory is true, then what about on a global landscape where so many of the emerging markets have underperformed India, and now that things are stabilizing on the global front, you've got a valuation comfort for the emerging markets. What if the FI money actually starts flowing towards there?
Some of that,
and you're seeing that this week as well.
Some of that play out today, for example. China saw that some bit of inflows, Reema. I think Prashant had highlighted this beautifully some time back, that India perhaps is now the only investable market in the BRICS countries, and I think that clearly is something that may play out. I think Naren also told me that China will see one wave of buying. Maybe that happens for sure.
All right, we need to slip into a very short break, but don't go anywhere. On the other side, we'll get you more market opinion. We've got a lot of interesting analysis on the new age tech IPOs, as new age tech companies, as well as the IPOs. Stay tuned.
Welcome back. You're with us here on Editors Roundtable. Well, let's shift focus now to the new age companies and what they are doing. By the way, Friday's session saw big gains across the board for these new age companies. Is performance improving? Is guidance improving? Nimesh is standing by on the big ball with all of the details. Nimesh, over to you.
Well, while all the platform companies are facing supply overhang, because we all know that the lock-ins are opening up in this month, but one must not lose the sight on the operational performance of these companies. Look at the calendar first. If you look at the calendar in this week and next week, Nykaa opened up for the lock-in opened up on 8th and 9th, and on 10th we saw a 4 crore share block, which is around 1% equity. On 10th we saw Fino Bank and PB Fintech opening up the lockup, and today we saw a big block, 3% equity change hands in PB Fintech, which is almost which is 3% of the company's equity. Next week we have Paytm and Delivery, both Paytm on 14th or 15th and Delivery on the 19th, where the IPO opens up. So, if you look at the performance of all these platform companies, Y2D or this year, maybe from the highs, these stocks are down anywhere between 50 to 75%. That's the kind of wealth erosion we've seen. Almost 50% of the wealth has been eroded in these companies in 2022. But the important point to watch out for is that the performance have started improving for most of these companies, and that was visible in Q2. So let's go with the first stock, which is Nykaa. If you look at Nykaa, this week, after the lock-in got over and some block, the stock is up 18-20%. But look at the performance. The gross margins has improved to 45%. versus 42% in YOY in quarter 2. And management is quite confident that 200 to 250 basis points of margins is sustainable. So that's Nykaa. Again, there was an interesting upgrade from BofA Securities this week, and they've upgraded the stock to a buy with an adjusted target price of 311 on Nykaa. Look at the other stock, which is PB Fintech. Now, even if you look at PB Fintech, there has been a strong performance in quarter 2. The revenues are up 27% versus the street estimations, and the contribution is also much better than what the street was expecting, up 63%. The adjusted EBITDA loss is half of what the street was expecting. So even there has been an operational performance which has improved for PB Fintech. The management is quite confident that the burn rate on the new initiatives will go below 200 crores. And by 2024 April, they are looking to return 1,500 crores of cash to the shareholders. The market cap of this company is just 17,000 crores. So that's an important figure if you go by the management. Now look at Paytm. Even that stock is down 52% this year, but the EBITDA loss of Paytm has narrowed again for the second consecutive quarter and has improved by 40% in this quarter, that is in quarter 2. In fact, the adjusted EBITDA break, and management is quite confident that the adjusted EBITDA break-even is possible and will happen by September 2023. So they are on track to have an EBITDA break-even by September 2023. Look at Zomato now. That stock is up 10. In fact, today, the stock was up 13%. In the quarter 2, profitability has been improving despite the steady growth. And the key surprise was the food delivery contribution margin has gone up to 4.5% versus just 2.8% in quarter 1. So there has been a clear operational outperformance in Zomato as well in second quarter. So, again, that's the whole point, that while there is supply overhang in all these stocks, but the key is that the operational performance is changing, and that's something to watch out for. So that's the basic analysis. While fundamentals are improving, there is a short-term supply overhang in all these platform companies.
Okay, Nimesh. In fact, let's continue with the topic. Good markets mean IPOs make a comeback. And Reema has actually done some interesting study and has got some fascinating data for us. Reema, tell us.
Well, the primary market action was very dull. In fact, in June and July, there were no IPOs which hit the market. In August, September and October, we just had about fundraise from the IPOs to the tune of about 1,200, 1,300 crores. Some small ones like Traxon Technology or Sirma SGS. These were the kinds of company that listed. Come November, with the markets now almost at all-time high levels, the valuations picking up, risk appetite back in the market, we've seen a rush of IPOs. Last week, there were 4 IPOs which raised money. This week itself, we had 4 IPOs which raised money. So totally, in the first half of November, 8 IPOs have hit the market, and they've pretty much raised close to about 10,000 crore rupees. This would take the 2022 fundraise to close to about 54,000 crore rupees. This is according to data from Prime Database. Now, this would still be much lower than what we had last year. Last year, primary markets were red hot, and the overall fundraise was close to about 1.2 lakh crore rupees. But right now, things appear to be picking up. Another important, indicator from at least the November IPOs is that the money which is being raised is not going for growth capital or capex. Now, if you look at the November fundraise, which is close to about 10,000 crore rupees, 65% of that money is actually an offer for sale, where existing promoters are bringing their stake down, or some of the investors are, again, reducing their stake or exiting, like BKG or 5-Star Fusion. These were purely offer for sales. Or even in Medanta, almost 70-75% was an offer for sale. So a chunk of it, 65%, is actually an offer for sale. In the balance 35%, which is fresh money which is being raised, almost 40% has been used by companies to reduce debt. So it's good that, debt is coming down. Debt reduction is always a positive. But the fact that companies right now at least are not raising money for growth is also a very strong signal from a market point of view.
So, Reema, in short, what you're saying is the bankers are busy with FPOs, with IPOs.
Year-end, right? Year-end pressure.
Year-end bonuses as well for them, right? So I guess it's good time for them.
Bankers are busy, which means Nimesh is busy.
Nimesh is busy, exactly. Okay,
Gives us something to talk.
Let's discuss this further then. We are now joined by Giri, Head of Research Division at IIFL. Giri, thanks a lot for joining us. The big talking point was on the kind of IT rally that we had and whether things have turned. What would be your view?
Not exactly, because there are 2-3 things to note here. One, when the Fed raises rates, there is the final intent is to cool inflation down, and that will happen when consumption comes down. And in the US, the consumption spending is quite a lot linked to the stock market. And if the markets rally, there is all likelihood that spending will stay reasonably strong. And I don't see how that will help bring inflation down. So it's a bit of a circularity. So the Fed has to raise rates, the markets have to break, then probably inflation will fall on a durable basis. But if a rally like this happens, like what happened in the US yesterday, and if everything goes up, including commodities, then inflation will probably be a little bit more stubborn. So in terms of expecting the Fed to go easy on rate hikes, we haven't seen the last year. That's number one. And number two, in the steady state, the way we see it, real 10-year yields are a reasonably reliable indicator. And they've been traditionally in the 1% zone. And in the US, they went as low down as -6%. They've come up to about -4% after yesterday's move, -3.8%. But that's still quite a long way below where it used to be and where it must have ultimately reached. So I think it's too early to say that, in fact, it's impossible to say that we won't see a large speed breaker confront the US economy markets, and the IT stocks are linked to the US economy. And I think I would rather prefer stocks in the domestic growth space rather than IT.
Giri, we are coming to the fag end of this earnings season as well. How are earnings looking to you, and what have they done to the full year estimates? What has Q2 done to your full year estimates?
Yeah, I think I've seen a number of sectors suffer downgrades to the FY24 numbers. FY23 is a bit volatile because only half the year is left. So looking at FY24, it's a bit hard to see where there have been very significant upgrades. I can see PSU banks, I can see financial services, one or two odd sectors, but otherwise it's generally across the board downgrades of between 0.5% to 3%, and some sectors even more than that. So I would think that it's not very surprising that downgrades are happening. People are pulling their estimates down because we've not really invested enough for growth. And globally there is monetary tightening happening, and some spillover effect will be there in the Indian economy also.
Thank you very much for outlining that. With that, it's a wrap on this edition of Editors Roundtable from the entire team. Thank you for watching. Have a good weekend.